4 crypto sectors are pulling capital because traders want revenue, usage, and real-world links, not one recycled narrative. The SEC4 setup tracks real-world assets, perpetual decentralized exchanges, prediction markets, and decentralized AI. The shared feature is measurable activity. These sectors are not relying only on token branding. They show collateral, trading demand, event market volume, or revenue. That does not make every project safe. It explains why capital is rotating toward areas where the numbers are easier to test. That is a different market tone from cycles where one broad theme pulled nearly everything upward at once. Real-world assets are the largest visible anchor. RWAs excluding stablecoins reached $29.4 billion on-chain. Tokenized treasuries expanded 18% month-over-month to $13.6 billion, and tokenized equities climbed above $1.2 billion. The mechanism is simple. Traditional assets are being represented on-chain so they can be used as collateral or plugged into DeFi lending and leverage. The attraction is not just novelty. It is external cash flow and a clearer link to traditional finance. Collateral is the important word. Once an on-chain asset can support borrowing, lending, or leverage, it can affect DeFi behavior beyond the original asset holder. Perpetual decentralized exchanges are the trading engine. Hyperliquid's HIP-3 reached $2.38 billion in open interest, a 580% increase over the past year. Perpetuals tied to traditional finance grew 188% in Q1 on the platform. Open interest means the value of active derivative positions that have not closed. High open interest can show demand, but it also creates liquidation risk when prices move fast. In the SEC4 rotation, perps are useful because they bring on-chain trading depth, not because leverage is harmless. That makes open interest useful and dangerous at the same time. It can deepen markets, but it also raises the amount of leverage that can be forced to unwind. Prediction markets are the event engine. Kalshi and Polymarket recorded $23.6 billion in combined trading volume during March, with both reaching all-time highs for 2 months in a row. These markets let users trade on real-world outcomes, which can create demand beyond normal token speculation. The risk is defensibility. Prediction market volume can move quickly to the platform with better liquidity, clearer rules, or stronger event coverage. Oracles and market infrastructure become the important layer because outcomes must resolve cleanly. Clean resolution is not optional. If users cannot trust how an event settles, volume can move away even when interest in the category stays strong. Decentralized AI is the newest revenue test. Tau reported $43 million in first-quarter revenue, 128 active subnets, and 70% of supply staked. Grayscale increased Tau's allocation in its AI fund to 43%. The attraction is a crypto-native answer to centralized AI dominance, distributed compute, open participation, and community-run machine learning. The risk is whether these networks can keep producing revenue and useful compute instead of only benefiting from the broader AI investment wave. The revenue number is important because it gives the AI sector a harder test than branding. Users have to pay for compute, models, or network services. The practical takeaway is that this sector rotation is less about one hot token and more about what can be measured. RWAs show collateral growth. Perp dexes show open interest. Prediction markets show real event volume. Decentralized AI shows revenue and subnet activity. The next SEC4 signal is whether those metrics keep improving after market attention moves. Durable sectors will keep users, collateral, and revenue. Weak ones will only keep the marketing language after the rotation slows.